Welcome back. We're on Leases, Module 11 of FARE, and go to page 32 of the FARE handout. Again, from the point of view of the lessor has to meet one of the four conditions that the lessee met, the owns, and the U and the C, the uncertainties and the collectability, etc. Then, if that's the case, the lessor has either direct financing or sales-type lease. Page 32 is sales-type lease. And in this case, from the lessor's point of view, cost basis does not equal fair value. The cost basis, that is the carrying amount of this asset on the lessor's books, that is book value, cost basis, whatever you want to call it, does not equal the fair value of that asset. For a direct financing lease, the cost basis, that is the carrying amount on their books, does equal the fair value of the asset on that date. Now remember, this is on the lessor's books. Now, with that distinction in mind, we're going to look at page 32, do some multiple choice, then look at page 33 for a direct financing lease, and do some multiple choice. Okay, so where it says facts, same as before, basis of leased asset is $70,000. Go back to page 31. These were the initial facts. Okay, so we're using the same facts now from the lessor's point of view. The additional piece of information we need is that the basis of the asset is $70,000. Okay, the basis of the asset is $70,000. In this case, the fair value will be assumed to be the present value. Present value is a measure of fair value. It's not necessarily the only measure, but absent any other information, that's the reasonable measure of fair value. They didn't tell us anything else. So the fair value is the present value. Okay, so where are we? The fair value is $83,398 on page 32. The basis is $70,000. The two are not equal. It's a sales-type lease. So the lessor has met one of the L conditions, one of the four, or excuse me, the L for the lessor is one of the four owns conditions, plus the U and the C. So the lessor has either sales type or direct financing. The basis and fair value are not equal. It's direct financing. Okay, now, journal entries, page 32 of your handout. The lessor will set up a receivable and credit a sale for that present value, which is the fair value. Then debit cost of goods sold and credit the asset at 70. Take the asset off their books. That is the asset that's being leased. Obviously, you take an asset off your books at its carrying amount. Now, look at these two entries. The lessor is immediately booking a sale and immediately booking a cost of goods sold. Those two items hit the income statement. There's an immediate profit recognition of the difference between those two. Okay, that's January 1x1 when this lease is first entered into. January 1x1, there's a payment immediately, only now it's the lessor, so it's a receipt. Debit cash and credit the receivable for $20,000. But the receivable has been set up at the net amount, the present value. So what we need to do is reflect the interest. So what we can do here is, at December 31, debit interest receivable and credit interest income. Go back to the amortization schedule. In this case, the lessee and lessor are using the same amortization schedule. Sometimes it'll happen, sometimes it won't. But for simplicity, in this example, they are. So the numbers have been calculated. Okay, the lessor recognizes interest revenue. Then on January 1x2, record the collection. Debit cash for $20, credit the lease receivable for $13,660, credit interest receivable for $63.40. Now again, go back to the second January 1 entry, debit cash, credit, lease receivable for $20. Remember, the first receipt of cash all amortizes the principal. There's no interest. Then at the end of the year, you book the interest income for the year and set up a receivable. Then on January 1 of the next year, you collect $20,000 cash, so you credit the lease receivable and you credit the interest receivable, and this would agree with the amortization schedule. At the end of the lease term, the receivables should all be written off. So what's the lessor doing here? The lessor is showing an immediate profit recognition with those first two entries, crediting sales and debiting cost of goods sold, and over the life of the lease, booking interest income. Now, direct finance, well, let's do a multiple choice on this. So this is sales type lease, page 446, number 21. Well, Peg leased equipment from Hal. So Peg is the lessee, Hal is the lessor. July 109 for 8-year period expiring June 30, 2017. Equal payments are $600,000 are due July 1 of each year. The first payment is July 109. Now watch the dates. That's immediately upon signing of the lease. The rate of interest is 10%. The cash selling price is $35.20. That cash selling price is the fair value. That's your better measure than a present value calculation. So use that. The cost is $2.8 million. The lease is appropriately recorded as a sales type lease. So they told you the type of lease. What amount of profit on the sale and interest revenue should Hal report for the year ended December 31, 09? Okay, the calculation, I'm going to erase this. The sale was made July 109. The profit on the sale is the full amount. Doesn't matter what date that happened. So that would be $35.20 minus the 28. So the selling price here, the assumed sale is $3,520,000, and the cost is $2,800,000. The difference there of $720,000 is the profit on the sale, and that's fully recognized no matter what date during the year this is done. So we've narrowed it down to A or B. The interest now, okay, the initial present value that we're going to use is $35.20. Since that's the fair value number, that's what we're going to use, $35.20. Okay, the first receipt of cash of $600 all amortizes principal. So that leaves $29.20 initially. Multiply that by the interest rate of 10%. Now, interest is a function of time. Watch the dates. The lease starts on July 1st, 09. We're going to December 31st, 09. That's 6 months. So times 10% annual rate times half a year. Interest is based on time. So the correct answer is B, second letter. Number 22. How company leased equipment to Q. So how is the lessor? Q is the lessee. January 2nd, 09 for 8-year period expiring December 31, 2016. Equal payments are $600,000 are due January 2nd each year. The first payment was made January 2nd, 09. The list selling price of the equipment is $35.20 and the carrying amount is $28. Same numbers as that other problem. The lease is appropriately a sales type lease. The present value of the lease payments is $33. So that's the number we're going to use, $33, because that's the lower number. What amount of profit on sale should Hal report? In this case, you're going to use the $33. In the other problem, we weren't given a present value, so we used the assumed selling price. Now we're using the lower one, the $3.3 million, minus the $2.8 million, so the profit is $500,000. Now go back to the handout, page 33. And let's take a look at direct financing lease. I'm going to erase the board. Okay, same facts as before. That is on page 31. But now the basis of the asset is $83,398. That was also the present value, which we're using as the fair value. So the basis, the carrying amount, and the fair value are equal. So once we've determined this is a capital lease for the lessor, that is other than operating, and we've determined that the carrying amount equals the fair value on that date for this asset, it is a direct financing lease. Direct financing lease is just going to reflect interest. Okay, journal entries. Debit the receivable and credit the asset for the $83,398 because that's the fair value and the carrying amount. You always take an asset off the books at its carrying amount. That is the asset being leased. Debit cash and credit the receivable for $20 because there's an immediate receipt of $20. It all amortizes principal. Then at the end of the year, set up your interest income and interest receivable based on the amortization schedule. And then on January 1st, you collect cash. You credit the receivable for the lease and credit the receivable for the interest. Actually, if you think about it, your entries for direct financing lease are easier than sales type lease because you don't have that immediate profit recognition, just the interest. So over the life of the lease, the lessor is recognizing interest income. Now, notice something about the sales type lease and the direct financing lease. In both of those cases, the lessor took the leased asset off of its books. Therefore, the lessor does not record depreciation on that asset. If the depreciable asset is off your books, you do not record depreciation. Now, with all that in mind, let's look at multiple choice on page 446, number 20. On January 108, J.C.K. signed a contract for an 8-year lease of equipment with a 10-year life. The present value of the 16 semi-annual payments in advance equaled 85% of the equipment's fair value. The contract had no provision for the lessor to give up legal ownership. Should they recognize rent or interest revenue in 09, and should the revenue recognized in 09 be the same or smaller than the revenue in 08? Okay, the first column. Is this an operating or a capital lease? Well, let's see what we have here. It says that it's an 8-year lease, 10-year life asset. 8 over 10 is 80%, so it's greater than 75, so that condition is met. The problem says nothing about uncertainties or collectability, so we assume that those conditions are met. This is a capital lease from the point of view of the lessor, so it's either direct financing or sales type, but it doesn't really matter because all they're asking about is rent revenue or interest revenue. It's rent revenue if it's an operating lease. This is not an operating lease. So the answer is interest revenue. And the interest is smaller each year. Answer D, fourth letter. It's smaller because the interest is based on the beginning balance of the principal. And the principal is being amortized. It's getting smaller. That was number 20. Number 25. Lease M does not contain a bargain purchase option, but the lease term is 90% of the estimated economic life of the leased property. Lease P does not transfer ownership of the property to the lessee at the end of the lease term, but the lease term is equal to 75% of the estimated economic life of the leased property. How should the lessee classify these leases? Okay, lease M does not contain a bargain purchase option, but doesn't matter. If the lease term is 90% of the economic life, it's a capital lease. And the other lease does not contain lease P does not transfer ownership, but it doesn't matter. The lease term is 75% of the economic life, so it's a capital lease. So they're both capital leases. B, second letter. Now, go to page 34, and let's look at sale leaseback. And go to page 449 in your book, because the best way to explain some of this is honestly with a multiple choice question. Okay, sale leaseback. Sometimes a company has an asset, but they can't afford to keep all the cash tied up in it, but they need it. So they sell the asset to someone else, and then they lease it back over a time period. So when they sell it, they get the cash, they lease it back and pay out the cash as rental over X number of years. Now, keep straight who's who. The seller becomes the lessee when they lease it back. The buyer becomes the lessor. Now, again, the company that sold it did it from a cash flow point of view. You might say, well, why'd the other company do it? The other company did it because once they lease it back, they're going to make a lot of money in rentals. It's going to be high rentals. So obviously, it's got to be a win-win situation, or both companies would not have entered into it. Okay, now, the question here is, if you look at page 34 of your handout, excuse me, how do you deal with this on the books of basically of each party? And we have to look at some criteria. So look at Roman numeral 2. This is considered minor if the present value of the future lease payments is less than 10% of the fair market value of the asset just sold. Major if it's more than 10%. So let me write this down as a little formula, because I think that's easier to see. Take the present value of the future lease payments. Present value of the future lease payments over the selling price of this asset. Less than or equal to 10%. It's in the minor category. Present value of the payments divided by the selling price greater than 10%. It's in the major category. Now, what difference does that make? Look at Roman numeral 3. The minor category, it's not a sale leaseback. Major category, it is. So what's that mean? No sale leaseback. That is minor. Roman numeral 4. Any loss is recognized immediately, and rent expense is recorded for each payment. Any gain is recognized immediately, and rent expense is recorded for each payment. In other words, this is treated as if it's two separate transactions. You sold property, you have a gain or a loss, then you have rental. Sale leaseback leases major, more than 10%. Roman numeral 5. Loss is recognized entirely. That's always the case. That's being conservative. Gain is deferred up to the present value of the lease liability, and then it's amortized. If it's an operating lease, the deferred gain is an offset to rent expense. This is on the books of the seller, who becomes the lessee. If it's a capital lease, the deferred gain is amortized to offset the depreciation on the capitalized asset. Now, let's look at some multiple choice to clarify this. So go to page 449 and look at number 48. The following information pertains to a sale leaseback by Mega on December 3109. You're given a bunch of information. What amount is the deferred gain that Mega should report at December 3109? So Mega is the seller, lessee. Okay, let's use our little formula. The present value of the lease payments is $36,900. The assumed selling price is $400,000. Now, you don't need an exact calculation. You're just looking for 10%, more or less. 10% of 400 is 40. If your numerator is less than 40, then that's less than 10%. Doesn't matter what the number is. It's less than 10%. That's all you need to know. Okay, less than 10% means minor. The rule with minor is that the entire gain or loss is booked. Now, let's look at the facts. Because, again, you got to be careful. Read it carefully. The sales price is $400,000. Carrying amount is $300,000. So isn't that a gain of $100,000? But the question is, how much is the deferred gain? None of it's deferred. It's all booked immediately. This is in the minor category. The answer is 0. Now look at 49. On December 31, 2009, Park sold Ed Lowe an airplane with an estimated remaining life of 10. At the time, Park leased back the airplane for 3 years. Additional information is as follows. Okay, now, the sales price is $600,000. The carrying amount is $100,000. So there's a gain there of $500,000. They give you a lot of facts, and then they say how much is deferred revenue in this transaction. Okay, the present value of the future payments is $190,581. The selling price is $600,000. Now again, 10% of $600,000 is 60. The numerator is bigger than 60, so this is greater than 10%. We don't care what the number is. It's greater than 10%. That's all we need to know. It's major. Major means the total gain of $500,000 gain will not be booked immediately. The amount equal to that present value, the numerator here, that amount will be a deferred gain. The rest will be booked immediately. So the answer to the question is B, second letter. Now, I'm going to make the journal entry the company would make. Go back to basics. Make journal entries. Don't be afraid to do that. This question, given these facts, there are various ways they could ask it. They could say how much is deferred revenue, which is what they asked, or they can say how much of the revenue is booked immediately. They're asking the same question a different way. Okay, what journal entry will the seller lessee make? They'll debit cash for $600,000. They'll credit the asset which has a carrying amount of $100,000. Equipment or whatever it is. Get that off your books. You're getting rid of it. Okay, then they will credit deferred gain, which is a liability, remember? And that gets amortized as revenue over the life of the lease. And that would be $190,581. And they'd credit gain, the amount of gain that goes on their income statement this year, to make this balance $309,419. Notice $309,419 is one of the choices. So you got to read it carefully. If the question said, what's the total amount of the revenue that's booked this year, or gain, that's the answer. The deferred revenue, the amount that's deferred, put off booking as revenue, is the amount that's equal to the present value of the future payments, the $190,581. Now, while you're here, let's look at 54. On January 1st, 07, Goliath entered into a 5-year operating lease for equipment. In January of 09, Goliath decided it no longer needs the equipment, and it terminates the contract by paying a penalty of $3,000. How should Goliath account for the lease termination costs? Okay, this is from the point of view of the lessee, and the answer is A. This is recognized immediately as a loss. The lease is finished. There's no future benefit. You gain nothing by amortizing this. So it's just booked immediately. It's A. And it would not be extraordinary. It's part of your normal operations. 55. In January of 07, Hopper signed a capital lease for equipment with a term of 20 years. In 2009, Hopper negotiated a modification of the capital lease that resulted in the lease being reclassified as an operating lease. Hopper calculated the company had a gain of $8,000 on the lease modification. Hopper retains all rights to use the property during the remainder of the lease term. How should Hopper account for the lease modification? This is treated as a sale leaseback. The answer is B, second letter. Defer the gain and recognize it over the life of the operating lease. Now, I want to point a few things out to you in the chapter and give you a little summary. And then we'll look at a simulation question. First, we're going to start with a little summary. Just some basic points in terms of capital or operating lease. Let's say operating, capital, lessee, lessor. Okay, operating lease, lessee will show rent, expense. The lessee does not set up the asset and liability. Capital lease, the lessee sets up the asset and the liability on its books. Remember, capital lease means the lessee meets one of the four owns conditions. The lessee sets it up as if they really own it, but legally they don't. The lessee sets up the asset and the liability. So the asset would be reflected eventually over its life through depreciation expense, would be amortized, and the liability, when it's amortized, would reflect interest expense. Lessor, operating lease would have rent income, and because the leased asset is on its books, assuming it's a depreciable asset, would have depreciation expense. In a capital lease for a lessor, the lessor would have interest income, would not have depreciation expense because the leased asset would have been taken off of the books, would have interest income, and if it's a sales type lease, would have a gross profit in the year of sale. ST is sales type. If it's a sales type lease, would have a gross profit in the year of sale. Remember, the sales type lease, the lessor booked sales revenue at the fair value and then cost of goods sold at the carrying amount. That difference flows through the income statement in the year of sale. So this would summarize what appears on financial statements under the different lease situations. Obviously, be familiar with that. Now, when you have a simulation problem, go to page 451. We'll walk through this. And again, if you know the material, you can handle whatever they throw at you, multiple choice or simulation. One of the things that will be in there is a research question, where they actually ask you to research the literature and answer some questions. You need keywords for that. If you make a note of this, page 443 of your text, page 443 of the text has a summary of some keywords that relate to that subject, leases. The secret there is read the question. Usually, whatever they're asking you, the key word is somewhere in there. Okay, for example, let's look at page 453. Let me just show you this first, since we're talking about it. 453. Right above where it says Simulation Problem 2. It says, research the following issues. Select your answers from the professional standards. How are leases disclosed in the balance sheet? So your key word there would be lease disclosures. How do we value liability for termination costs to cancel an operating lease? So operating lease termination costs. What is the minimum lease payment and what items are included? So minimum lease payment. These would be your key words. And again, you find the answer and you cut and paste, or they'll give you instructions as how to deal with it. But remember, you want to narrow down as much as possible. If you type in a keyword leases, you'll get too many hits. You need to narrow it down. Okay, let's look at the beginning of this simulation problem. I'll walk you through simulation problem 1, and I would strongly encourage you to do simulation problems 2 and 3 on your own. Again, and do all the multiple choice. It's a good review of the material. Go back to page 451. On January 2nd, 2009, Nesbitt leased equipment from Grant. So Nesbitt is the lessee. Grant is the lessor. Lease payments are $100, payable annually every December 31st for 20 years. Title passes to Nesbitt at the end of the lease term. So it is a capital lease. Equipment has a $750 carrying amount on Grant's books, estimated life 25 years. The rate implicit in the lease, and it's known as 10%. The incremental borrowing rate is 12. We're going to use 10. The lessee uses the lower of the two. The lessor uses the rate implicit in the lease because they're the one who established it. Nesbitt uses straight line. Present value factors are as follows. We're using the 10%, so the 12% numbers are irrelevant here. Okay, prepare journal entries. Okay, the journal entries initially, of course, are for the Nesbitt. Nesbitt is the lessee. On January 2nd, 2009, debit the equipment and credit the liability at the present value, which would be $100,000 annually times the 8.5, which would be $850,000. Making the lease payment on December 31, 2009. Reflect the appropriate interest. And this is end of period. Reflect the appropriate interest expense. Reduce the liability and depreciate the asset. And that's what number 3 actually is asking for. Now, let's look at the answer list. The next part of this. The terms listed below refer to lessee and lessor accounting for operating, capital, direct financing, and sales type leases. For each item, select the best phrase or description from the answers listed in A through Q. Any answer may be used once, more than once, or not at all. Okay, so with the simulation question, you need to understand what are they telling me and where am I supposed to go with it. What are they asking me to do? Okay, so we're given an answer list. And go to 452. We're given some terms. Okay, now, given the term, you need to match that with an item on the answer list. Okay, number 1 is sales type lease. The answer is D, 4th letter. Now, strategy point. When you have a long list like this, my suggestion would be read the question, which is essentially numbers 1 through 15 on page 452. Start looking at the list A through Q. Start with A, start reading it till you find a description that you think matches the term on page 452. Put down that letter and go to the next one. Don't keep reading. While ideally that would be a good thing to do, it'll take too much time. It's not worth the time and effort. So you're going down the list, A through Q, until you find something that answers the question. Direct financing lease. Go down the list, and you should find I. Operating lease lessee. B, second letter should do it. Operating lease lessor. F should do that. Now again, go through the rest of this on your own. It really is a good review of these concepts and some of the issues that go with these concepts. Now, look on your question, page 452 in the middle. Nesbitt has the following rental agreements. You have been asked to advise the accounting treatment for each item, and the space provided indicate whether the agreement is operating or capital. Nesbitt rents equipment for 3 years for $20,000 per year. The equipment is valued at $200,000. At the end of the rental term, the equipment must be returned to the dealer. This sounds like an operating lease. Nesbitt rents equipment for 5 years for $80,000. At the end of the rental term, Nesbitt can buy the equipment for $500,000. At the date the contract is signed, the equipment has a value of $300,000. It's expected it will have a value of $42,000 at the end of the lease term. At the end of the lease term, $42,000 is what we think it'll be worth. We can buy it for $500,000. That is a bargain. Bargain purchase option, capital lease. Again, all you have to meet is one of the 4 conditions. Nesbitt received 6 months of free rent on an office building, leasing for 2 years. That would be operating lease, but they'd have to use straight line, as we discussed earlier, for the rental expense portion, that is. 4, Nesbitt rents equipment for 8 years. The present value of the lease payments is $80,000. The market value of the equipment is $90,000. Okay, so let's see. The useful life of the equipment is 10 years. We rented it for 8 years. The asset's life is 10 years. 8 over 10, 80%, greater than 75%, it's a capital lease. By the way, the 90% test is not met here, but that doesn't matter as long as one of the 4 conditions is met. Number 5, Nesbitt rents equipment for 10 years. At the end of the lease, Nesbitt receives title. Title passes, that's a capital lease. Notice they're testing you on the conditions for a capital lease. And 6, Nesbitt rents equipment for 7 years. The life of the equipment is 10 years. The fair value of the equipment is $100,000. The present value of the minimum lease payment is $85,000. Okay, so the life is 7 over 10. That's less than 75%. The other one is 85 over 100. That's less than 90%. The problem said nothing about title passing. We assume it doesn't. Said nothing about a bargain purchase option. We assume it doesn't exist. They'd have to tell us that. None of the conditions met. It's an operating lease. This was a good review of the conditions. And then they ask some questions. And again, this is typical in a simulation. They'll ask you some basic questions, and you have to type in a response. Okay, write a brief memo explaining the following. I'm at the bottom of 452. How should Nesbitt account for the sale portion of a sales leaseback transaction? Why is the appropriate method of accounting, etc.? And again, it depends on the major or minor and how much of the gain is deferred. And number 2, how should Nesbitt report the leaseback transaction or the sale leaseback transaction on the balance sheet? And that depends on whether the leaseback is an operating lease or a capital lease. Brief explanation. Type a couple sentences, get to the point, say what you have to say. Don't keep going overboard. Make sure your sentences are properly constructed. Plural noun, plural verb. Singular noun, singular verb, etc. Expect the simulation to be a variety of parts like this. Maybe some matching, maybe a multiple choice, something you got to type in a response, and something with research. That's usually what they do. That completes our discussion of